morning. Welcome to this special edition report of RIA Advisors. This is particularly for our clients. I'm your host, Lance Roberts, Chief Investment Strategist. Want to talk a little bit today about what's happening in the markets, specifically because of the actions the Feds have been taking over the last few days. Beginning last Friday, the Federal Reserve put a $1.5 trillion worth of liquidity into the markets. Then on Sunday, they launched QE, $700 billion, and dropped interest rates to zero. On Monday, the market closed down 3,000 points. Then on Monday and Tuesday, the Fed have now launched more programs to provide more liquidity to banks and to firms across the country. Massive amounts of liquidity here, yet the markets have not really responded as of yet. The issue is, will they? I suspect that at some point the markets will begin to respond to all this liquidity sloshing around in the markets, but the real issue is, did the Fed act too early at this point as the markets continue to go through this kind of liquidation process? The real question is where is the bottom of this market? The answer is, I don't know. We can simply take a guess at this point, but the Federal Reserve is hitting this market with a tremendous amount of liquidity. The federal government is now talking about $1 trillion stimulus package to help businesses, to help homeowners, to help individuals with more money. You know, these are all good things to help stem some of the economic impact from what's happening with the virus. But as an example, a $1,000 check to a family today or even next week with the economy effectively shut down doesn't really do a whole lot of good. I can't go out and spend it in the economy in terms of consumption. So I pay down debt, I put it on my mortgage, I try to catch up on some past due bills because I've been laid off. That will certainly help, but that doesn't stimulate a tremendous amount of economic growth. So the problem is the markets are having to factor in the impact to earnings over the course of the next several months. We are 1 month into a new recession. The longest economic expansion in history, 129 months, ended in February. Now that we're only 1 month into a recession, we still have on average about 17 more months to go for a recession and a lot of work to do. Markets are trying to price in what the economic impact is going to be to job losses, rising jobless claims, the fact you're going to have lower revenues and lower earnings for companies all across the board, impacts to small businesses, medium-sized businesses all across the country. That's what markets are trying to factor in here, and it's early at this stage of the game. So back to our original question, where is the bottom of the market? I don't know. But the answer is that we broke this long-term trend line that goes all the way back to 2009. We talked about this on Monday in our report. This has set up a situation where we no longer want to participate with the markets to any great degree at this point, and we have reduced equity risk in our portfolio now down to the lowest levels that we're going to have. We're going to hold our current positions at current levels until we can find an eventual bottom. With almost 50% cash, we have a lot of opportunity here to wait for the market to begin to recover and start to show us a real sign that things are beginning to improve, and we have plenty of time to try to come back and put that money back to work as the markets begin to actually recover. We can see a recovery in earnings, a recovery in economic growth, life getting back to normal, and putting that money to work where our risk reward is much better. Currently, it feels like we should try to speculate and time the bottom, but bottoms of markets are never formed when everybody wants to buy. At true bear market bottoms, when we get there, nobody will be talking about wanting to buy this market. All they'll want to do is stay in cash. So again, I want to assure you that we're paying attention to your money very carefully. We're more concerned about capital preservation at this point than trying to create returns. We are going to take advantage of some opportunities to trade opportunistically if we see a decent risk-reward setup where we can participate with that fairly safely. We'll run very tight stops on positions going forward, and we'll make sure that for the most part, we're preserving your capital for the future and making sure that you're safe. If you have any questions, be sure and get by our website, realinvestmentadvice.com. Send me an email. Let me know what I can do for you. Danny, Richard, all of our advisors here to help you as well. So don't hesitate to reach out and ask any questions that you have. You're very important to us, and we want to make sure that you know we're paying attention to you. Thanks for watching.